you're getting a bit of an echo, can you turn your microphones off, please, because it will just sort of rattle around. So this has been something that I've been thinking about for quite a long time, and the sort of recent crisis has really hardened some of my thinking around this. So the sort of general sort of agenda for today is I think I'll set out a few basics on markets and a few caveats on what I'm going to say. I think it's worth trying to quantify how big the economic impact of lockdown has been. And so there's lots of statistics and numbers that you could put around that, but I think there's some other things that are somewhat more compelling. And I'm going to talk a little bit about what's been happening in the market, and I'm going to talk a little bit about sort of news and information and what that really means in the context of financial markets. And then I'm going to talk a little bit about the government and also investment for the long term, because I think there's some really quite worrying things that have happened over the past decade or so. And I think there's a real risk of catastrophic things to come. What you'll realise over the course of this presentation is I'm an optimist. So I always have a really sunny up disposition and positive outlook in life. And so I think there are some major challenges, but actually I'm somewhat optimistic, but I think it's going to take a huge amount of rethinking about how we do things. So basics and caveats. So one of the things that is often asked is what returns will the market generate, or what will the markets do? And that's actually, for me, completely wrong. That is the wrong question. And the reason it's the wrong question is markets don't generate returns, companies do. And so just now, and over the past decade or so, there has been this move to be unduly focused on markets and what the market is doing. And actually, that's the wrong focus. What we should be focused on is what are companies doing, because it's companies that generate returns, it's companies that make money. And at some point, then we would hope that if you've got a company that's listed in the stock market, that cash and income generation would be reflected somewhere in the market price and in the way in which returns could be given back to shareholders. So I think that misconception is really problematic because it creates a policy approach where I think the focus is wrong. And so on one of the final slides, I talk about an insurance mindset. And what we're really thinking about there, and it's something that's been talked about in the US quite a lot because of the Fed, is markets are no longer what we think they are. And central banks in particular have got a focus on stabilising the market. And that starts to create some interesting problems. The other thing, I suppose, that we've got to think about is information and prices. So within academic finance, there is an awful lot of time and effort and intellect spent on market efficiency. And there's lots and lots of different theories of that, probably the most famous being the efficient market hypothesis. Roughly speaking, it won a Nobel Prize in economics, but it's in many respects precise and wrong, and it's not without its criticisms, but it's useful to the extent that it allows us to think about information and prices and how prices could respond to new information about a company or a product line or the general state of the economy or the world economy. So one would expect that information and new information should be reflected in prices. So if we get good information, then we should readjust our expectations up the way. And if we get negative, bad information, we should readjust our expectations down the way. And so prices should go up on good information and down on bad information. The other thing, which again is worth setting out, is the difference between risk and uncertainty. And this is something I've spent a lot of time on. And it's a distinction that has often been lost. And if you read a book like Radical Uncertainty by John Kay and Mervyn King, which came out quite recently, you start to understand the history of what was going on in economics around these concepts. And I think the distinction is very important. And without hopefully generating lots of discussion about who was right on this, if we take the sort of view of Frank Knight, risk is something that we can have some expectations around based upon lots of data points and statistics. So we could have some probabilistic expectation of an outcome. Whereas uncertainty, we just don't know. So the difference is really quite fundamental when we think about what is it we're going to make an investment in. And one of the things which Frank Knight said was essentially that entrepreneurs are rewarded for making investments under uncertain conditions, and where they do that well, then they profit. And that was what Frank Knight was trying to understand. And I've got to caveat my learning of this by a paper that Bill Gerard, who I know is on this presentation, gave me yesterday. And that's quite interesting because it's very different when we think about how markets are viewed. And one of the ways in which markets are often conceptualized is with this understanding of all things being knowable. There is a probability distribution that can be applied to everything. And that really comes out of the Chicago School of Economics in the 50s, and particularly around Milton Friedman. And so if we think all things are knowable and conceivable and we can do statistical analysis around them, then that probably leads us to a bad place because it's clearly not possible. Other things are caveats around this. One is there's too much noise just now and not enough signal, and that's actually because we're dealing with uncertainty. So if we're in a time of risk, ignoring how we might want to try and measure and conceptualize, then there's probably signal that we can start to pick up on and deal with. Actually, what we have just now is uncertainty. We don't know, and that's it. We don't know. And so when you get into that situation, people are very, very driven by noise rather than signal. The other thing we have is complexity. And the complexity of what we have just now is unparalleled in lots of different ways. And the final thing is something about being wrong. I'm very happy to be wrong, and I am frequently wrong. So almost everything that I say is highly likely to be wrong in some way, shape or form, but hopefully it's going to give some pause for thought. So the next one is to try and think about what do we mean by the economic impact of lockdown. So there's lots of statistics we'll see, and some of them we'll look at later. But I think to get an idea of the scale is to think about human activity, and can we look at this sort of globally and try and see some sort of signal. So this slide here, this is nitrogen dioxide in China. And so nitrogen dioxide basically comes out of pollution where we've got fossil fuels being consumed and things like cars driving on the road. And so if we look to the one on the left for the 1st to the 20th of January, what we see is quite a lot of nitrogen dioxide concentrated towards the north of China and a little bit in the south, a little bit to the west. And so when we then look to the one to the right, that is the shift in nitrogen dioxide over China. It's almost non-existent, and that's because the whole country's in lockdown. And if you've ever been to China, that will give you some idea of the scale of what we're talking about. And what that is also picking up isn't just people driving, this is commerce. Think of all the productive industry that goes on in China, and it's almost all stopped. It's absolutely staggering for me when you see it that way. And if you go into the NASA Earth Observatory, there's other versions of this, so you can see India and so on. And if you spend a bit of time, you start to get an idea of just how much things changed. This is more recent, and what we see is that nitrogen dioxide level has ticked up quite a lot. And we can start to see even in Wuhan, it's starting to pick up again. So what we can see here is the lockdown in China being eased, and we can see places like Shanghai, Hong Kong, Chongqing, Chengdu, and so on, Xi'an, all starting to increase. And so places we know are pretty industrial starting to rise again. But for me, that gives a real sense of the scale of what we're talking about, because I think it's very difficult to think about it globally. And then for where we're at just now, so this is out of the IEA Global Energy Report for April 2020, and this is global energy-related CO2 emissions and annual change between 1900 and the current year. And so far, 2020 in the lockdown has been the largest on-record decrease ever of CO2 emissions. And when you look at that red block at the end, you see just how big it's been, and that's likely to continue to go down for the next couple of months because the world is still relatively restricted. And so again, in terms of about this globally and how behaviour has changed and how things are not like they used to be, this has given again some idea of the scale that we're talking about. So if we think about markets then, and what's been happening in markets, basically the US post 2008 has been on the longest economic boom ever. And today there was some news out that suggested that that came to an end in January. And for about 12 to 18 months, people have been getting very nervous about the general position of the markets. The president has been very bullish about the markets and how they reflect economic growth and various aspects of his policies and so on and so forth. Whether that is true remains to be seen. But I think the bottom line, which is 2.75%, that's the FTSE 100. So actually the UK hasn't done a huge amount in terms of the main market and the sort of largest companies. It's been pretty lackluster over the period. But if we look at the Dow Jones Industrial Average, if we look at the S&P, they're up around 120 to 128%. And then if we look at the NASDAQ, since the financial crisis, it's up about 304%. So that's quite interesting. And what we actually see, if we just look slightly earlier in terms of the graph, so from the far right-hand side, just in a little bit, over the dip, that dip is where lockdown sort of started. And what we see is quite a significant sell-off in markets. Markets went down by about a third. And then all of a sudden, on various policies, we see the market spiking again. And as of yesterday, more or less, the markets had wiped out all the losses. So the losses that had been incurred over lockdown basically disappeared as of yesterday. But we've also got to think about some of what's underlying that. And so this is the FANG. So this is Facebook, Amazon, Netbook, Apple, and Google. I didn't do it in the right order, but anyway. And so what we see is these companies are absolutely huge, and these companies have been doing well in the lockdown. So if we think about Amazon, it's up 40%, and Amazon wasn't a cheap stock to start with. Netflix is up 35%. Apple is up 22.5%. Facebook is up 15%, and Google's up about 7%. So actually, given the relative size of these companies in the overall market, then when you see that level of performance there, the overall buoyancy in the market isn't necessarily reflective of the market as a whole when we start to think about constituents. So there's some skew in the performance of the market, which I think is probably not discussed enough. There are businesses in these markets that are likely to fail. So I think Hertz, for example, filed for Chapter 11 bankruptcy protection. So there are bad things in the market, but the overall picture is sort of glossing over some of the underlying things that are there. The other thing that we have is price earnings. So this is how much are you willing to pay to own a dollar of earnings of a particular company. This is the average PE ratio, and it's at the highest level we have seen since the early 2000s, which led us to the dot-com. So we're seeing lots of signs that markets are still overvalued, and this starts to come back to this problem, as I see it, of this disconnect between markets and economic fundamentals. The other thing I've seen is, if you look at all the sort of policies that have been implemented, so zero interest rates or very close to zero interest rates by governments, and that then means having money market funds, for example. So highly liquid, low risk funds don't generate you lots of money, but people do invest in them for lots of reasons. Having your money in at zero isn't particularly sensible. And what we've seen is quite significant outflows into high yield corporate bonds. And so if you look at, this is the top 10 years, and if 2020 is half of those years. So in the past decade, half of the years that have had the largest flows into high yield bond funds have been in the past couple of months. So again, there's something skewing here, and it's really driven by government. So when we look at this, we've seen some interesting policies. So the government and the Fed in the States, for example, has started to buy exchange traded funds that invest in corporate bonds. So we have investments, standard investment products that are usually desirable and quite widely sold, being bought up by the Fed. And we've seen some odd market pricing recently around ETFs in particular, where the actual net asset value and the market price were out of kilter, and so it was very, very odd. And so the government is stepping to support bond products. It's also stepping in to support companies, sort of listed equities and things like that. And so if you think about somebody who wants a low risk product like a money market fund, why wouldn't you go and invest in something that's going to give you a higher yield when the government's underwriting you? Because you're now supported by the state, and this creates moral hazard problems. And we've seen quite a lot of this around the global financial crisis and the solutions thereafter, because we sort of did get hyperinflation, but not where everybody thought we would. What we've seen was massive inflation of asset values, and so people who were better off and exposed to assets have done very well over the financial crisis, and people who were exposed to income have done pretty badly, because actually wages and so on have been pretty stagnant for a lot of people. And so this policy response has unintended consequences. So the other thing about markets is markets are meant to reflect news and information. So this came out last week. The unemployment rate in the US falls unexpectedly to 13.3%. And so we'd seen some really stark unemployment data the month before, and everybody was quite concerned about the scale of this, because it's depression era unemployment, and that's still with the government trying to support people in lots of different ways. So the markets really rallied around the fact that there was 2.5 million jobs added. And so when I read that in the FT, the first thing I always do in the FT is start to read the comments. Quite interesting, the perspectives you get, and this was the first comment. Now, essentially, it says there was a misclassification in the Bureau of Labour Statistics household survey, which is something that the Bureau of Labour Statistics admitted to and said, but basically they don't ever go back and fix their data. And so at the same time as you've got this news story of the market really boosting and being buoyant, saying that this is a sign that things are going to be better, it was based upon incorrect data. And so this gets back to this idea about what is it that market is pricing, because the market is meant to be able to understand some of the things that are signals and some of the things that are noise. And right now there are still 21 million people unemployed in the US. And so the market's ignored that, in my opinion, because those people might not be gainfully employed for quite a long time because the economy is so uncertain. And so just now we get to this interesting point with markets and how we think about them as responding to information and being able to become some sort of barometer of the real economy is really problematic. So they're not working effectively just now. In the UK, we see other things around the bounce back loans. The UK banks warn 40 to 50% of these borrowers will default. But the banks were very, very loath to lend until the government actually says we'll under 100% of these loans. So you write them, we'll guarantee them. And so the banks are now quite happy to write these loans, but we have a real problem if 40 to 50% of these loans are essentially defaulted on. And the banks are probably quite right that if you start to pursue small businesses for bad debts too aggressively, it's going to be really bad for the banks. And so the banks have been quite good in this financial crisis in terms of helping to support some of the immediate things that were needed. But we do have another problem where this isn't lending as we would have it, where you're doing due diligence to the same extent. So banks are going to be stopping fraudulent applications, multiple applications, and so on and so forth. But really, this is the government lending via the bank as an intermediary. And so this is all the state that's intervening in the real economy. If we then think about the UK economy a little bit, the OBR March 2020 forecast for household debt of all types is going to rise from 2.068 trillion to 2.425 trillion by 23-24. If we assume that the population evolves in the same way as the ONS projects, then that's about £86,500 a household debt. And that was before COVID. And so again, when we think about the level of debt that we're seeing in the economy, we have a real problem. So we've got the banks basically funneling government money through to all corporations who make a request, and we have massive amounts of household debt. And so when we think about our expectations for the economy going forward, then they should really be quite flat just now, and the markets don't really seem to be pricing that in. So where does this get to? Well, this gets us to a problem. So markets are meant to be very effective for allocating capital, i.e. we make investments, and some are really successful, some are okay, and some are bad, and those bad investments are weeded out. And if we were thinking about a school of thought in economics, we'd probably go to the Austrians and say it's a process of creative destruction. And that is not what's happening anymore. That is not what is happening in stock markets, and it's probably not what's happening in other parts of private equity or sort of bank-based finance to smaller businesses, because we have so many companies that are now surviving on 0% interest or very, very, very low rates of interest, very, very low cost base because of wage suppression, and actually they're not really contributing to productivity in the real economy. And so we're starting to have this fracturing of these sort of core links. And so the real economy then has no way of allocating to good investments. And what I find sort of ironic about it is if we think about the way in which markets would always be perceived in films and movies, we would think of things like Wall Street or The Wolf of Wall Street or Smartest Guys in the Room, in this very combative and cutthroat sort of scenario where everybody's out on their own trying to make money just for themselves, and they don't care about the sort of short term and who goes bust and all the rest of it. And it's not like that. It's essentially socialised markets. And so we have private profits and socialised costs just now, and everybody's losing out because we've not got that fundamental link to the real economy anymore. And what we have is this insurance mindset. And that insurance mindset is, if you think about the central bank intervention, well, if the central bank has an insurance mindset, then I can pile into the market. And if I'm wrong, that the economy is not going to bounce back as quickly as I think, then the central bank is going to stand behind me. And if I'm correct that the economy is going to be better, then I still get upside. And so no matter what I do just now, if I'm an investor and I go into the markets, then I'm good, because either the central bank's going to underwrite me and bail me out, or the economy is going to tick up and I'm going to be fine. But that's not how this is meant to work. And we then have other problems. So what happens when most of private capital finances government debt? Essentially, we are implicitly saying that the government is the most appropriate body for making long-term investment decisions. It's no longer financial markets. And it is not clear to me that the government of any country, and particularly the UK, makes good long-term investment decisions. And so there's a real problem there. And so productive investment in the real economy is going to be more and more steered by government, and that fills me with real dread for economic growth. We also have a problem when private capital is invested in the financial economy. So where we're washing money around the stock market, where we're washing money around the bond markets, where we're not actually participating in capital raising, secondary offerings and so on, when we're just buying and selling from each other, that doesn't actually trickle through into the real economy. That remains in the financial economy. And so it is very, very bad for productivity and growth. And so for me, we've got ourselves to a very, very worrying position with regards to all of this. And the long-term outlook is really quite concerning when we think about productivity and growth. And as you've already seen, what we've probably had over the past decade or so, and what I'm very worried that we're going to continue to have, is zombie companies. Companies grow and succeed when other companies die. If we can't have that process of creative destruction and manage that better, we're not going to have the right amount of investment in the real economy, and that then really disadvantages the majority of people, because it is only GDP growth, and we can argue about what GDP actually measures, but it is only real economic growth that benefits everybody. If all we see is financial growth, that only benefits a very, very small tranche of the population. And that's me for questions, if we have any.
Thank you so much, Iain, for this sobering talk. I think you have given us plenty of food for thought, and there are quite a few questions. I think some questions, in a way, you have already answered, but however, I'd like to kind of pick those up, and these relate to how do you see the markets performing then over the short mid-term?
I think the markets just now are in a sort of win-win position. So the idea of the policy solution that was probably appropriate around the global financial crisis, they've never really had a way of unwinding that. And so that's always created this false bottom in the market. And as it stands just now, they've taken a similar policy approach. And so markets, I think, are going to be okay. I think they'll be decent in terms of returns, but there has to come a reckoning. It cannot continue like this, because they're no longer functioning properly, and that then really hits the real economy badly.
In response to your concerns there, someone also asked whether this is now a case for a global bank.
No, I don't think a global bank would solve this. I think what we have to think about is innovative solutions, because there are more solutions to this that probably sit outside a very narrow tranche of policy perspectives that sit in places like the Treasury. So just now there's probably quite a lot of groupthink that sits in places like that, and it might take something a little bit more revolutionary to get us past this.
Well, I mean, quite a few people comment now that you said that you are an optimist beforehand, and they struggle a bit to actually bring this in line. But of course, yeah, these are very serious times. Gary, he also raised that if it is your bottom line about government not being a good allocator of capital due to the fact that the government has been captured by the financial market players, are you then saying that the financial market dynamics as a whole are out of control and actually standing in the way of a real kind of bottom-up recovery in what you've called real growth?
Yeah, I would agree with that. Very short answer to Gary's question.
Are there any other reasons that to be optimistic?
Yes. If we think about other challenges that we have in the long term, things like climate change and global warming, one of the things that is most obvious about this crisis is we can do things very differently en masse and quickly. And so when we think about some of the conditions that could be attached to the support that companies get, then I think the green question could be much, much stronger and more forcefully pushed around the sort of the conditions around which people do receive support, particularly large corporations and so on, because this is a moment in time which is hopefully never going to be repeated, but essentially you could start to really push people in a particular direction so that we get that greening of the economy and a much quicker transition to a low carbon economy.
Yes, I think that is indeed a positive direction to look at. But then we also had some questions beforehand around the implications of this for inequality. Would you like to say something about that as well?
Yeah, so I mean, if you look at the policy solutions to the global financial crisis, and actually there's a wonderful article in the FT today that started to talk about this as well. So it's not clear how much of this was my thinking, how much was from reading this in the FT. But if you look at the way in which people who are exposed to assets, so there's some crazy statistics around something like 10% of the US population owns 80% of the stock market. It'll be something bizarre like that. So that to own that much of the stock market, you've got to be pretty well off. And so the past decade or so has been very, very beneficial to people exposed to assets, which is not the majority of people. Most people are exposed to labour and income. And so actually they've had a decade or so of pretty flat income. And so the inequality question, I think if the solution to this crisis is the same as the last crisis, it's quite likely we're going to see the same thing again, where inequality becomes ever more entrenched.
Yes, I think that makes a lot of sense, and of course fills us all with concern. The last questions were more around what can we actually do. So George commented that last week you spoke to 127 Scottish actuaries, presumably most of them having this kind of insurance mindset. And the question is now, what can we do to kind of change their approach, or maybe at least to consider alternatives?
Yeah, so the actuaries thing is an ongoing project of mine, trying to help the actuarial profession and working with them to understand different economic perspectives and try to think about economics as a toolkit rather than a sort of hard science. And so you've got to be able to understand much more about it in a broader sense to be able to then work out, try to answer the question, what is really going on here and how do we then do something about it? The insurance mindset is really something that comes around the central banks, because just now they're thinking about protecting markets and possibly to a degree that's unreasonable. And so we should really see a little bit more volatility and a little bit more creative destruction, which sadly means companies going bust. But if we actually had that, people will lose money. That much is acceptable to me in terms of where we're at. We need that process to come back so that we can really work out who the winners are. And by working out who the winners are, we can then start to innovate around that. And we can also see more opportunities for companies to grow. Just now, if you are a large company that is surviving on fumes and government policy, then actually you're sucking resource from somewhere else in the economy, potentially. And so that's where I have the concern.
So related to that, do you think then that tax relief on corporate debt should be changed or even scrapped?
Yes, it should be scrapped. It creates perverse incentives. And so it probably had some use when it was first established, possibly 100 or so years ago, but actually now it creates perverse incentives. I think equity capital and risk capital needs to be much more prominent in the balance sheets of companies.
Thank you so much, Iain. We now had James Tucker asking that, is this a positive time now for smaller investment managers who, when speaking to CEOs and scrutinizing company accounts when investing, can establish perhaps better the thrivers from the survivors?
Yeah, I mean, I think so. There's sort of large global trends around investment. One of them is the move from active investment, active equity to passive equity, and that makes a lot of sense in a world where the cost of active fund management is quite high and the relative performance is quite low. But what it also means is the market has to be held at all times, and so we don't have that ability to start to make judicious decisions about who's a good prospect for the long term. And so I think boutique fund managers on a reasonable cost base are probably going to be able to do quite well, because they are going to be able to be more nimble and start to pick out future growth companies. And I think that will be very useful in trying to come through this.
Thank you so much, Iain. I see at the moment we have no new questions in the chat box, but there were some questions submitted beforehand. So to all participants, if you have further questions, please feel free to use the chat box located on the right-hand side of your screen to put in more questions. One of the pre-submitted questions related to whether you want to elaborate a bit more specifically around emerging markets and whether we see a different pattern there.
Yeah, so with emerging markets, I think the real problem is the markets themselves are relatively underdeveloped, and so they're not as resilient. And it's not clear just now whether or not the central banks of those countries would be able to step in the same way. But there's some really worrying statistics about the impact the current crisis is going to have on their economies. And so some of the statistics that came out yesterday suggest that the economic impact is going to be horribly severe in emerging and developing economies. And so the question of markets is one thing, but so those markets are probably not going to be able to develop at the same pace, because the underlying economy is going to be so weak. And that really has to be something that concerns everybody, because the advances such as they are that have been made around poverty alleviation can be unwound very, very quickly. And so we need to think slightly beyond our own borders too, because mass poverty in other pockets of the world, while everybody in the developed world is doing okay again, is not an optimal outcome for this.
Well, you can definitely say that again. So thank you so much, Iain, for commenting on that aspect as well. Since I didn't manage to introduce you properly earlier in your expertise also in pensions and related issues, I would like to do so now in view also of another question that was submitted beforehand, with a view to a recent article you wrote with Con Keating, where you said, or where you called apparently for a bonfire of past pensions regulation. The person who submitted that question wanted to ask whether you could briefly comment on this and explain a little.
So the things I write on pensions are sometimes not uncontroversial, which is it's better to be infamous than not recognised at all, potentially. So the problem we have just now with pensions regulation is the underlying premise of the approach to valuing pension liabilities is discounted cash flow. And so in this, the discount rate matters. And the way in which pensions regulation has evolved is to do it based on a sort of financial economics approach. And the discount rate is set with reference to something like a AA bond yield. And the problem with that is that doesn't actually reflect the terms of the pension. So Con and I have written about this quite a lot, and really we've got to go back to the terms of the pension to arrive at the right discount rate. If you have the wrong discount rate, then it leads to other problems, one of them being, in the case of pensions, significant increases towards government debt and index-linked government debt and other sort of fixed income products. And that again shifts huge amounts of capital from what we would have liked to have thought of as competitive capital markets, where there's a risk premium that could be captured over a long time period, which a pension fund in some instances should be going for, not every instance, but it's not an unreasonable place for them to start. And we just see this move into bonds and bond-like products. And so if we are having pension funds buying up significant amounts of government debt, that's financing the government. That means the return on that debt comes from the government. And so the return on that investment is going to be extremely low. And essentially, you're guaranteeing poverty in retirement by investing in government debt. You're also, as a second consequence, increasing the likelihood of deficit recovery contributions. So that's money coming out of corporate balance sheets and going into the pension fund to buy potentially more financial assets. That again exacerbates the problem. And so what you're saying is, well, where should company money be invested? Should it be invested in the bond market, or should it be invested in real economy investments? And if we put all our money into deficit recovery and financial investments, where does the real economy get invested in? So how does a company expand or whatever else? And if we don't have enough of that, we don't get enough economic growth. And so we end up a cycle of woeful productivity and lackluster growth.
Thank you so much, Iain, for unpicking this really complex web of factors we need to examine. For someone who's not in finance, I found that tremendously helpful. Thank you so much. In the meantime, we also received one more question. George again asks, he says, interest rates are on the floor, but can you see them going negative from here? Corporates may reduce their debt if they no longer get tax relief, but how do we protect the overborrowed consumers and also the elderly who may have savings which earn no interest and may even be subject to bank charges as negative interest?
So I'm coming round to the idea that we need a debt jubilee. So historically, when you've seen times of severe crises, then you've had a debt jubilee. And what we're talking about here is the government will essentially create money out of thin air and give it to every single person in the country with conditions attached to it. The condition being you've got to pay down all or some of your debt. So if the government had to give out 25,000 per person and you've got to pay down your debt with that, so you might pay off your credit cards, some small loans, maybe put some into your mortgage, then you're good. If you've got no debt, you get £25,000. And so what it allows you to do is start to reduce the overburdened consumer. And it also allows people who have been more frugal to keep their relative position. And if you've got people who are going to be getting the debt jubilee and getting to pay down debt, then we could think about ways in which we could be more restrictive in credit to them in the future, not forever, but for a set period of time, to try and get things back to some sort of better balance. If you just look at some of the consumer debt stats and the growth of consumer debt, people are working to service their debts. They're not working for other things. And so again, that's why economic growth is so lackluster. But for a government to think about that and do that, that's what I mean. We need radical solutions to this problem. That's only one, but it's one which I'm coming round to thinking might be quite a good thing. And there is precedent for it because it started, I think, in ancient Mesopotamia. So it's not a new idea.
Wow, that is fascinating, and indeed, I think plenty of food for thought there in that particular idea. I think we are slowly coming to an end in the sense that I haven't seen any new questions posted, and I would like to ask if there are any final comments you would like to add. It was such a wonderful talk and really, really helpful, these explanations afterwards. Thank you so much, Iain.
Well, thank you very much. No, I don't have anything else to add, but if people want to get in touch with me, just drop me an email or contact me on LinkedIn. I'm more than happy to chat about all of this. So, and thank you for taking the time to listen to the ramblings of a madman.
Oh, these were certainly not ramblings and not of a madman. I think we all learned an awful lot today. Thank you so much, Iain.
And
I would like at the very end now to just remind everyone that Iain's talk is a talk of within a series of webinars we are currently hosting, with the next one coming up next Tuesday on entrepreneurship. Again, we get now lots of positive comments of people confirming not mad at all and really great talk. Thank you so much. Then if you want to listen to Iain's talk again, it will be soon, within days or so, in this archive we are putting together with all the other webinars. So that if you want to return to one or two of the arguments, listen to it again, you will definitely have the opportunity to. Once again, a big thank you to everyone, in particular Iain, and I wish you a wonderful afternoon.